They note China's record gold ETF outflows. Sideways gold meets rising stocks is essentially the vibe from it. Chinese gold ETFs saw record outflows in July as retail investors rotated into rising domestic equities. Bloomberg framed this as gold is stalling. That's not a quote. Sideways was their word. But structural forces suggest otherwise. China's accelerating M1 money supply supports both equities and gold, supporting inflation and challenging Western central banks' 2% inflation targets. Now,
according to Bloomberg, in July 2025, Chinese retail investors withdrew a record approximately $450 million from the country's four largest onshore gold ETFs, Huaan Yifu, Bosera, Fund, and Guotai, as they booked profits from gold and rotated into local equities. While ETFs witnessed sharp outflows, China's equity markets showed a strong upturn. The CSI 300 index rose approximately 5.5% that month, indicating strong momentum in Chinese stocks. Additionally, Chinese market trends suggest that capital is increasingly flowing into equities rather than traditional safe havens, which contributes to inflation and undermines Western central banks. These developments are driven by both domestic policies and global economic forces collaborating in real time. Lanci, a precious metals analyst and author, reports that in July, Chinese investors are reportedly shifting away from gold-backed exchange-traded funds to equities, with outflows poised to reach a record high this month as the bullion price rally has stalled. Some investors are booking profits from gold and rotating into equities to chase stronger momentum. He also told the news publication that retail investors are driving the outflows. Gold prices have rallied this year, driven by U.S. President Donald Trump's tariffs, which have increased safe haven inflows and weakened the dollar, as well as heightened geopolitical tensions. The price rally has cooled off in recent weeks as Washington, D.C. has struck several trade deals with key allies, including the EU and Japan. However, Fidelity and Goldman Sachs still see room for a further spike in bullion prices based on some key catalysts. The stagnation in bullion prices has occurred at a time when investors have become increasingly confident in Chinese equities, as the government's efforts to curb pricing wars and overcapacity have bolstered hopes for improvement in profitability. A trade truce with the U.S. has also proven to be a boon. China is the world's largest physical bullion market. While the country's ETFs are smaller compared with global counterparts, they offer local investors one of the easiest ways to get exposure to the precious metal. As we begin the video, remember to subscribe and press the bell icon to stay up to date. We value your feedback, so please leave a comment and give us a thumbs up if you liked the video.
That Bloomberg is expanding its data business in China and benefits from equity optimism. In fact, they note in their report that commodity equities are doing very well. So gold's price remains in a consolidation near record highs, unlike underperforming Chinese bonds, which are getting slammed as people go risk on. Retail repositioning appears tactical, not foundational. The story is less about abandonment of gold and more about general reflation entering China's market space, set against the backdrop of deepening global liquidity and strategic reallocation, all of which is bullish for equities in China, for sure. For gold, and for commodities in general. So we had the full analysis in the premium post. Bloomberg notes China record gold ETF outflows, as well as the link to their story. That's the story. I guess editorially speaking, they left out that the first half of 2025 was record inflows for gold ETFs, like massive inflows for gold ETFs in China. So if you look at gold globally, India is buying ETFs now. So go figure. It just seems to be rotating around the world. The next story is Fed decision day, why a rate cut is very unlikely, at least that's our opinion. The Federal Reserve is not expected to adjust interest rates at its upcoming July meeting. That's today. Despite persistent calls from some officials to ease policy, I think there's two that disagree, which is the broader committee appears inclined to keep the federal funds rate unchanged. The decision reflects a growing divergence between rising inflation in goods categories and softening private sector employment growth. We have a couple charts here we're going to pull up for you as soon as I can get them sorted. The first chart is inflation. Now, the light orange line is the one-year inflation swap, and it's indicating the middle of June, an increase short-term inflation expectations. So the Fed, that's a guide for the Fed. And if they're swearing by the data, that's got to stop them from being more aggressive cutting. We don't know if they're swearing by the data anymore or what data they're using. The other thing we'd say, just to give you a counter to that, is a lot of that data was based on the expectations of tariffs really cooking the books on inflation. And it hasn't done that yet. So perhaps that beginning of a downtrend there is something more significant. So that's the inflation side of it. Inflation, by the numbers, says it's really not a good idea to cut. Unemployment is also interesting. We may be at the beginning of a bigger trend here. Okay, so unemployment's been muted. It's been steady, but there is a change in the mix. Now, the orange, that's the private sector hiring people. And all we've been hearing about is people getting laid off now because of AI, and that's valid. The orange, the darker orange sector, that's government jobs. Now, the blue are our markings. These charts are from Bank of New York. The blue are our markings. If you take an eye and you look starting, say, when or December when Trump started, you'll see that the new hires for jobs were private sector almost entirely, with very little of the government hires adding to the payrolls. And that's probably in part Doge scaring government into not hiring people. In June, government workers seem to be filling the gap again as private sector hiring drops. And the blue rectangles on the left, that shows you where they were big last time under Biden. And so you have to wonder, is unemployment really worse than it looks? And are we going to see a big downtick in that? So I think right now, until we actually see a manifestation of people not working, people getting laid off at a faster pace, the Fed's going to hold off on its cut. The bottom line is unemployment isn't high enough and inflation is creeping up again, at least perceived to be creeping up again. I would say that the street is expecting 2 cuts. So not July, yes to September, maybe, and yes to December, definitely. Wall Street's been dovish, more dovish than the Fed for 2 years now. 4 years, actually, when you think about it.
Vince Lanci reveals that, despite repeated Fed disappointments, U.S. stocks are at record highs, likely due to a mix of fiscal stimulus and market optimism, which may be forming a bubble. Gold has entered a range-bound consolidation phase, moving sideways for roughly 3 months since its April highs. It's currently hovering around its 50- and 100-day moving averages, reflecting soft volume and seasonal summer dynamics typical in precious metals. Traders are closely watching for a breakout in either direction, whether it will be a continuation of consolidation or a renewed trend, characterized by contracting price ranges between support $3,450. A break above resistance could signal fresh upside momentum toward prior highs near $3,500 and beyond, while a break below support could open room for a deeper correction toward $3,200 or lower. Traders often await a confirmed breakout, preferably accompanied by volume, to validate their directional bias. Vince Lanci expects risk-on silver to benefit in the next phase of dollar weakness driven by global reflation efforts, especially from China. Silver, up 33% year-to-date, may surge toward $43 if the gold-silver ratio breaks below 86. Unlike historical silver bull markets characterized by explosive parabolic moves, the current uptrend has featured moderate impulsive rallies followed by multi-week consolidations. Silver has been moving less impulsively than historically observed, notes Gumis. This measured advance suggests genuine physical demand rather than speculative froth driving prices higher. Well, let's go back to the interview.
The ironic thing is, as an editorial comment about stocks, the ironic thing is, despite Wall Street being dovish and being disappointed by the Fed time and time again, stocks are at all-time highs. So either that's a bubble expanding, or that's the fiscal spending going towards making America great again. It's probably a little bit of both. Moving on to the charts. Starting with gold, those are the moving averages. As you can see, we're just messing around with the 50-day moving average, and gold needs to pick a direction. We did have a false direction pick here, right? I was long and got stopped out. The 100-day is coming along. When the 100-day approaches the 50-day, your speculators will start to pay more attention again. Which way, you don't know yet. But usually when the market creeps up to the 100-day, when the 100-day creeps up to the market, you have even more volatile sideways movement. I don't know, but that's what I've seen historically. And then it picks a direction. So we could be this way for a while. And I would remind you, bull or bear, we have now been, after making this high in April, May, June, we're 3 months into this sideways action. And I can't see this being a top. Now, of course, I'm biased. We had 2 months of sideways action before the spike up after December. So just keep in mind that I think the rest of the commodity markets are catching up. Just to paraphrase Hartnett, gold was the outperformer in phase one of dollar weakness. And now, because it's recessionary dollar weakness, we're worried about recession. Now you'll see risk on commodities outperforming in phase two, which is because the world's going to start goosing economies again. And I think he's been spot on that. I mean, oil is showing that to you now. All right, moving on to silver. Those two dotted lines are my levels, so maybe silver is establishing a new trading range up here. I don't know. But there seems to be a battle now. If you think there's going to be a reflation or an expansion of an exporting of inflation coming out of China, then you buy copper, then you buy silver, or maybe you buy copper and you look at silver. If you think there's going to be more tariff risk, you buy gold and copper. Anyway, it's hard to say, but hey, we're up 33%, I think, year to date. So I think the gold-silver ratio, once it cracks 86, will go to 79. Again, gold-silver ratio below, I'll pull that up for you. Gold-silver ratio below 90, 2.5 points away, should get us to 79, which puts silver at around $43. I also want to look at Bitcoin. Everyone's buying Ethereum right now, and interesting how Bitcoin is just kind of ledging. I don't know what to make of that, except I know that somebody's involved in the market, either propping Bitcoin up and catching it while everyone's selling Ethereum, probably BlackRock or Sailor. But just something to watch. It's very, very artificial, that market, especially since it pierced it, went back above it. Oil, very busy chart. Those two lines are legacy lines from the last time I identified a trading range. Well, we're back in it. It's hard to say, but if you believe that China is going to inflate or increase its money supply, and you believe that the U.S. increasing its money supply, whether it happens today or later on, then you want to start buying risk-on commodities. So basically, it's risk-off commodities when they thought we're going into a recession. Now it's risk-on commodities when they think we're going to have a boom. But we're probably going to have a boom. Anyway, I'm Vince. Gold's up $4.50 now. Silver's down 20, and copper's down almost 4. I'm Vince. Have a great day.
The evolving dynamics in Chinese markets underscore a transformative rebalancing of assets. As Chinese investors shift from gold to stocks, with ETFs seeing a record outflow, the meticulous change in capital highlights both tactical and strategic reassessments. Observers must continue monitoring indicators for emerging opportunities. Market strategists note that Chinese investors are swapping gold for stocks as ETFs experience a record outflow, which is a critical indicator of shifting global financial priorities. What exposure options exist for gold investing? Why are commodity stocks gaining interest? Can market volatility reverse the current trends? We'd love to hear your opinions, so please leave them in the space provided below. If this video was helpful to you, please give it a thumbs up and remember to subscribe for more.